more than just business news, we're news for business people.
Good morning, you're watching All You Need to Know on Bloomberg Quint. I'm Darshan Mehta. Joining me on the show is Agam Vakil. Agam will speak about the FNOQs. I'll talk about the general trade setup, and it looks extremely strong at this point of time because the SGX Nifty is indicating a strong outlook. So 45 points up, above the 10,600 mark. We closed at record highs, so the traction for the Nifty continues to remain. So clearly there is strong traction that's coming in on the Nifty. Even some of the ADRs did well. Dr. Reddy's, Infosys, Tata Motors, all of them managed to surge in trade. What didn't do well was Wipro as well as HDFC Bank. As far as crude is concerned, crude is down almost 1%. It was 1% down on Friday. Currently opened with modest gains in the morning session. As far as commodities are concerned, weak closing for commodities on Friday on the LME. Aluminium was down 2%, lead was down 2%, copper was down almost 1%. As far as nickel and zinc were concerned, they were also down in trade. Tin was up almost 0.6%. COMEX copper trades up by almost half. We're trading mildly in the positive, but opening by commodities in China is extremely weak. You name the commodity and it's down. Copper, aluminium, rubber, steel, all these commodities are trading with a negative bias. As far as gold is concerned, it was down on Friday. It's open muted currently in morning trade. Flows, FIs were net buyers to the tune of 580 crores. DIs were also net buyers. They bought in 240 crores. So on a month-to-date basis, if you're looking at it, 1,085 crores of net buying by the FIs in the cash market. DIs have sold in close to almost 937 crores in the cash market. Overall, it was a strong day for the Nifty. Fourth session of gains, and Nifty closed at record highs. The SGX Nifty is indicating 10,600 is possible. But the broader markets have managed to outperform. The mid caps, the small caps, they're doing well. IT did well in trade, one of the best performing indices. What didn't do well was, the PSU banking space. It was down in trade. Now the Nifty was up almost 55 points. What did well? HDFC, Yes Bank, IndusInd Bank did extremely well. Bharti Airtel contributed. What didn't do well? ICICI, SBI, Infosys, and Bharti Infratel. But it clearly is on the side of the gainers. But Agam, record highs, probably 10,600 mark. What kind of put writing are we seeing on the FNO side?
Well, Darshan, you hit the nail right on the head, because it is the 10,500 mark where we are looking at a lot more writing, which means that 10,600 could very much be a possibility. That said, let's take a look at what's happened when it comes to trade on Friday, and we are looking at fresh longs building. And despite the fact that the indices have only moved up around half a percent, we've seen 5%, 5.5% gains in open interest for the Nifty Bank futures, and for the Nifty, beg your pardon, for the Nifty and for the Nifty Bank futures, we've seen another 8% addition towards open interest. Moving in, as far as your VIX is concerned, that's also fallen down, still above the mark of 13, so we'll be watching out for that. But the Nifty put call ratio, of course, edges higher to around 1.58 as against 1.54. In terms of changes in open interest, as I was mentioning earlier, it is the 10,500 put that is seeing more writing, which can be taken as a positive for all those who are long on the index. That said, in terms of changes, we have Reliance Communication, which moves back into the FNO band, but there are three stocks that I'd like to bring out on the back of fresh longs. So United Breweries is one, 44% added as far as open interest is concerned. Equitas Holding is the other, 15% added in OI, and along with that we also have Just Dial, which has also seen nearly 10% increase in open interest. So a lot of stocks out there in the broader markets which are gaining, despite the fact that we've seen subdued moves from the benchmark indices. So we'll be watching out for these as we move into trade today.
Stock of the day is Goa Carbon. Good set of numbers coming in from the company. Yet again, if you look at the revenue, that's a good 160% jump that we're looking at a number of around 187 odd crore as compared to 72 crore that we've seen in the corresponding quarter. Net profit is some multifold jump there at a number of 23 23 crore as compared to a lost figure that we were looking at in the corresponding quarter of less than a crore. EBITDA for that matter, operating performance has been decent enough for this company. If you look at that, that number is shot up to 38.3% as compared to 2 odd crore that we've seen in the corresponding quarter. Margins have expanded to a sharp 21% as compared to 2.6%. On account of lower favorable base, that is really working out well in the favor of this company. If you look at the factors which have been contributing towards the growth of the company, it will be the cost reduction in the raw material as well as your employee benefits expense. Now, raw material expense as percent to your net sales, that number has come down to 70% from 79% earlier, and employee benefits as a percent to your net sales too has come down to 2.3% as compared to 5.7% that we've seen in the December quarter of the last year. Also, if you look at the reduction, there is a sharp reduction in finance cost and a higher jump in other income, which has led to a good sharp performance in your bottom line along with your operating performance, of course. Other income has jumped over 3 folds to a number of 4.4 crore as compared to 1.26 crore that we've seen in the corresponding quarter. To just give you a rundown of what the company is, while the manufacturer of calcined petroleum coke, which has a good market capitalization of around 924 odd crore, it's a sharp run up that this counter has seen in a span of good 1 year. We've seen the stock rallying as much as 700 odd percent. The company has been on a debt reduction drive and has a healthy dividend payout ratio. With that, let's toss it over to Jayesh for commodity market update.
Thanks for that, Nikki. Let me start off with oil prices, which actually posted the best opening week for any year since 2013. So for the entire week, last week, it was up more than 1.7%. Now, this was on the back of US output, which actually rose to 9.78 million barrels a day for entire of last week. The entire last week was not so good for the base metal pack. On Friday itself, the index declined about 1%, and it posted the first weekly drop that we saw since early December. As far as individual base metals are concerned, aluminium was up, it was down 2%, which was the top loser amongst the 6 of them. Lead was down about 1.8%. Copper and nickel also declined about 1% each. Tin was the only outperformer, which actually gained 0.6%. Moving on to gold prices, we saw gold futures post the best rally in about 4 decades on the back of dollar index slipping below the 92 mark. Now, gold hasn't seen 11 straight sessions of gains since early 1975. That said, let's shift focus to Saloni with currency market update.
Thanks for that, Jayesh. Let's start talking about rupee. It extended its winning run for the second consecutive session on Friday, and it ended at a 32-month high of 63.37 levels against the dollar. Now, a record-setting rally in local equities along with global dollar weakness largely supported the rupee's big move. Now, remember that the home currency has strengthened by a good 55 paise since the start of 2018. Meanwhile, India's foreign exchange reserves surged by $4.5 billion to a new record high of $409.4 billion mark for the week ended December 29, 2017. Now, on the global front, dollar declined for the 4th straight week, thereby marking its longest losing streak since May 2017. Dollar index dropped largely after the data showed that the US economy added 148,000 jobs in December, which is well below the forecast of 190,000 jobs by the Economist. Well, coming back home, dollar rupee is trading at 63.28 levels against the dollar in the non-deliverable forward market, which indicates a stronger opening for Indian rupee in today's trade. Moving on to bond market, the sovereign bonds gained on Friday after Economic Times reported that RBI is looking to pay special dividend to government, thereby reducing their borrowing for this fiscal year, and hence yield dropped to its lowest level in more than a week at 7.29%. And lastly, global funds reduced their rupee debt holdings on Friday by roughly 60 crores according to NSDL data.
Among the stocks that we're tracking today morning is JP Infratech. Now, this is on the back of a ET report which said that Tata Housing and Lodha are interested in acquiring JP Expressway, and the companies have made initial bids for the same. So keep an eye out on JP Infra. We're also tracking NBCC. Now, we might see a positive reaction on the back of an order win of 2,000 crores. Now, this order win was on account of developing Green Road project for Eco Tourism Development Corporation. accommodation, so keep an eye out on that name. That apart, we're also tracking Sobha. Now, the Q3 new sales volume stood at the highest in the past 11 quarters and are valued at 751 crores. Realizations also improved marginally as compared to the last month, up about 2 or 3%. So we could see some positive reaction there. The other stock that we're tracking is Sagar Cements, where the December sales grew 65%. So again, we could see some positive reaction there. That apart, we're tracking Force Motors, where the domestic sales for the month of December came in at 1900 units. This compares to 2100 units last year, but do remember that while the numbers look weak on a year-on-year basis, on a month-on-month basis, Force Motor sales volumes have improved, so we might actually see a positive reaction there. That apart, we're also tracking Sun Pharma. Now, this is on the back of a ET report over the weekend that US FDA may inspect the important halal site in February, so keep an eye out on that name as well. CMEC is another one, smaller company, but they've entered into a charter party with GOPL Offshore. Now, this deal is for the charter hire of vessels CMEC 3 for about $2.4 million. That's close to 15 crores or so. So we might see some positive reaction on this name as well. A PTI report says that GSPL plans to raise up to 1,000 crores via QIP, and they may also raise up to another 2,000 crores by listing its Oman business. So that's another stock to watch out for. That apart, on the back of bulk deals, we had Snowman Logistics, where Norwest Venture Partners 7A sold 1.5% stake. Now remember, they had about 9% or so that they held in the company as of September 2016, so keep an eye out on that name. On the back of earnings, we have two companies, Uttam Galva, where revenues fell by about 36% and the net loss, however, narrowed from 257 crores to 180 crores. And lastly, we're also tracking Videocon. Now, these are the Q2 numbers, where the company's revenue fell by 69% and the net loss widened from about 400 crores to 1,000 crores. So those are some of the stocks that you need to track in trade today.
At 6.5% GDP growth for fiscal 2018, the growth numbers released by the CSO, which by the way are the first advanced estimates of GDP growth in the current fiscal, are more or less in line with expectations, although mildly disappointing. The Bloomberg consensus estimate had pegged growth at 6.7%, so at 6.5%, you get a sense that the economy is struggling along, and that's exactly what it's doing. It is struggling along. Various segments of the industry are doing so. Before I get to the sectoral breakup, the GVA growth numbers, which are tracked a little bit closely by policymakers, are suggesting that growth is at 6.1%. Actually, the bigger disappointment is on GVA growth because remember, the Reserve Bank of India at the December policy had said it expects GVA growth of 6.7%. So the bigger miss is on GVA growth, which takes out the impact of subsidies and also of indirect tax payments. Underlying economic trends is what is getting reflected in the GVA number, which continue to show some amount of weakness, perhaps on account of the twin shocks that we've gotten to the economy in the last 15 odd months, which is demonetization and then GST. Where are we seeing the pinch on the economy? Well, one thing is the farm sector. It's disappointing to see farm sector growth at just 2.1% in a year when you had a normal monsoon. The problem is that the monsoon was delayed in some parts, certain parts had floods. So agricultural output this year has been weak, even though the monsoon season overall was normal. So the farm sector has been a disappointment. Manufacturing at 4.6% growth versus 7.9% is also a weight. Now remember, in the second quarter you had seen some pickup in manufacturing. It's possible that when you get the final read on Q3 and Q4 you see stronger numbers on manufacturing, but so far based on the extrapolation of the numbers available, the CSO expects growth in manufacturing to be weak at 4.6%. Other segments I want to flag off: construction is slightly stronger than last year, as is the financing and real estate segment. The public administration part, which is linked to government spending, is predictably weak. They're expecting that to grow at 9.4% this year compared to 11.3%. That's a consequence of the fact that the government's finances have been strained. If you look at the expenditure side data, the trends that are coming out in the full year data are pretty much the trends that we've been talking about in the first quarter and the second quarter data. Gross fixed capital formation, which is an indicator of private investment in the economy, is seeing some pickup at 4.5% compared to 2.4% last year. Siddharth Sanyal of Barclays India, who was with us on an earlier show, said that let's not pop the champagne yet because this slight improvement is on a very low base. Private consumption has weakened a touch, but nothing dramatic. At 6.3%, private consumption is lower, or growth in private consumption is lower than the 8.7%. And then finally, government consumption, again linked to government finances, is weak at 8.5% compared to 20.8% last year. So that government part is really pinching the economy on top of everything else that has been sluggish. Just a last point on nominal GDP growth. Nominal GDP growth is at 9.5% compared to double-digit 11% growth last year. Nominal GDP takes on importance because a lot of the tax revenue projections are built based on the nominal GDP number. So a weak nominal GDP number will put the government in a bit of a spot even when it's preparing next year's budget. And remember, next year's budget numbers are based on the first advance estimate. So overall, the take on the economy is it's improving, but it's not improving particularly rapidly, at least not based on these numbers.
Whenever there is asset price inflation, you have to ask why it is that way. And clearly there are some supports for it. Growth is strong for the first time across the world. You're seeing Europe come back very strongly in the last few quarters. Japan is going the normal way it goes, a country with a labor force declining at 1% a year. You know, for it to grow at 1.5% is great. And the US is doing reasonably well. So with all the engines firing on the real side, there is some optimism. The concerns have to do with two factors. One is the monetary side, and second, the financial side. On the monetary side, when do we see inflation? If in fact you have strong growth, you have economies at levels of unemployment which haven't been seen for a long, long time, when do we see more wage inflation? When do we see that translate more into goods inflation? That's the question on the monetary side. When that happens, you will find interest rates picking up more strongly, and of course that will have an effect on asset prices. The other factor is the financial side. How much debt have we built up in these years, in these go-go years, on the retail side, on the government side, on the corporate side? You know, covenant-light loans are at an all-time high at this point. So the question is, at that point, when interest rates start picking up, when liquidity seems a little less available than it is now, do we see a substantial reaction on the financial side?
Well, that's the question. When does this stop becoming just a talking point among academics on Twitter and become something that policymakers need to address?
Well, the question is, what do you do to address it? And I think the best thing that can be done at this point is a steady removal of monetary accommodation as the economies look strong. Let's not try pushing it to the last limit. I think as you remove monetary accommodation, you signal also that the financial side needs to adapt, and you give them time to adapt, which is important. So the buildup of leverage that you see, both the implicit leverage in positions as well as the explicit leverage in debt, I think that will start tapering off if in fact there is a signal that accommodation will be taken off. Now, you have to do it in a steady way because you could affect asset prices considerably if it comes as a shock.
But you don't think the argument that we can let rates stay where they are because we're not seeing any inflation is worthwhile?
Well, I think central banks obviously are forward-looking. They have to ask, is this going to stay the way it has been, going forward? And the one thing that is changing is earlier you had slack somewhere in the world. Today, with unemployment coming down across the world, the sense has to be that there's less slack. And as a result, the comparative pressures across the world, which kept wage growth down, may not show up as much going forward. So wage growth will possibly pick up. You already see inflation in some countries, Canada, for example, picking up more strongly. The second aspect of this is really central banks are also at the back of their mind thinking about financial sector risk. That it's not the front of mind is inflation, but if financial sector risk is also building up, we should not surprise the world suddenly with an inflation report which shows we are way behind the curve. So I think that would suggest, so long as there's this uncertainty, steady, slow removal of accommodation makes sense.
In an important release, the tax department announced that going forward, there will be no minimum alternate tax liability on companies facing insolvency proceedings. And here's why this is important. So far, what was happening was, let's say a company, a stressed company, had a debt of 100 rupees. And because of the loan write-off and the interest write-off, that debt came down to 50 rupees. The 50 rupees that the write-off was happening goes into the P&L of the company and is taken out, is looked at as the gains by the company, on which there is a 20% MAT levy. Well, the tax department has said now that effective FY 2017-18, this loss that is so far was being seen as the income of the company will not attract MAT. Why is this important? Because so far the bidders were pricing their bids taking into account this tax cost, and now what will happen is that these stressed companies are likely to get a better value for the assets, and also the lenders will get a better value from the incoming investor.
Well, some other stocks to watch out for based on the cash market volume as of Friday. First up, we have Yes Bank, which was up about 5% and saw delivery buying in excess of 430 crores. The delivery volume was up 130% at nearly 1.3 lakh shares, 1.3 crore shares as compared to its 5-day average, and the total volume surged about 3 times at about 3.2 crore shares as compared to its 5-day average. Indiabulls Housing Finance, the other stock to watch out for, it was up over 1% and saw delivery buying in excess of 250 crores. The delivery volume surged 160% at about 22 lakh shares as compared to its 5-day average, and the total volume doubled at about 27 lakh shares as compared to its 5-day average. Last and final stock to watch out for, United Breweries, it was up 6.7% and saw delivery buying of almost 100 crores. The delivery volume more than was up 208% at about 8.5 lakh shares as compared to its 5-day average, and the total volume also surged more than 3 times at about 23 lakh shares as compared to its 5-day average.
On the big brokerages, first we have Kotak Securities and Mahindra Logistics. Now they have initiated coverage on the stock with a buy rating and a target price of 520. Now Mahindra Logistics is well placed to leverage its unique asset-light business model and its large client base, according to Kotak Securities. Mahindra Logistics is most asset-light third-party logistics service provider among the listed logistic companies, and the shift towards third-party logistics would drive growth for Mahindra Logistics going forward. Now the brokerage is also expecting the non-auto sector growth to accelerate to double-digit growth going forward. The business of Mahindra Logistics has a scope to expand into other avenues like cold chain, cargo movement, etc. Now the brokerage is expecting the timed resolution of the issue of the tax deducted at source exceeding the payout based on corporate tax to normalize the working capital requirements for Mahindra Logistics. Now they are expecting its revenue, EBITDA and net profit to grow at a compounded annual growth rate of 24%, 31% and 30% over FY17 to FY20. Lastly, the brokerage says that Mahindra Logistics is trading at a premium to its peer, which is justified given the growth prospects that the company has. Second, we have is Angel Broking on CCL Products. Now they have initiated coverage on the stock with a buy rating and a target price of 360. Now CCL Products is India's largest manufacturer and exporter of instant coffee with about 24% market share. Now, the company's hedge business model has created a healthy moat. Also ramping up of facilities to foray into newer markets is positive when it comes to CCL Products. Now Vietnam expansion of CCL Products is an excellent strategic move according to the brokerage. Now this plant would further expand to export to countries like China, USA. Now the company's robust business model has created a good cash flow for the company, which has kept its balance sheet strong and return ratios healthy. Going forward, the Indian retail business will be another booster in the near term according to the brokerage. Lastly, CCL is expected to maintain its 17% plus growth trajectory over FY18 to 20 backed by its capacity expansion and newer geographical flooring.
There are also several stories that you should consider reading on the website bloombergquint.com. Here are just a couple of them. Desi cuisine and yoga will mark the start of the 5-day annual jamboree of the rich and powerful from across the world in snow-laden Swiss ski resort Davos later this month. India will be in the spotlight with Prime Minister Narendra Modi expected to be present for the first time. Temperature extremes across the globe spanned more than 85 degrees Celsius at the weekend as Sydney was scorched and parts of the US froze. Western Sydney touched 47.3 degrees Celsius on Sunday afternoon, the city's hottest day since 1939. Weekend temperatures at Mount Washington Observatory in New Hampshire plummeted to minus 37 degrees Celsius. Well, that's all we have for you on this edition of All You Need to Know. Up next is Indian Open. Do stay tuned. This is Bloomberg Quint.